Hi, this is Jonathan Lopez, President of Platinum Wealth Management. Welcome to our 2015 year-end stock market update. What I want to do today is look at the performance of the stock market over the last 5 years and see if we can get some insight into what we might expect over the next 5 years. They say that past performance is no guarantee of future performance, which is true, but it often gives clues. So let's take a look at what the market did over the last 5 years. In June of 2010, the S&P 500 was at 1,083. 5 years later, it had almost doubled to 2,079. That works out to an annualized return of 13.93%, not counting dividends. Not so bad. So what caused that strong growth? Two things: earnings growth and PE multiple growth. You can see that from 2010 to 2015, the S&P 500's earnings per share grew from 67 to $102 per share. That's an earnings growth rate of 8.81%. At the same time, the PE ratio on the S&P increased from 16 to over 20. Those two things, strong earnings growth and PE ratio expansion, combined to give us an almost 14% return in the S&P 500 over the last 5 years. Now the question is, can we expect more of the same for the next 5 years? What we really want to know is, should we expect the same rate of earnings growth in the next 5 years? And should we expect the same PE ratio expansion in the next 5 years? So let's take a look at the market and economic landscape over the last 5 years. We were coming out of the 2008-2009 bear market. The unemployment rate was near 10%. We had quantitative easing rounds 1, 2, and 3, and we were in the very early stages of the business cycle. Really, there was almost no place to go but up. Compare that to where we are today. We are coming out of a 6-year bull run. The unemployment rate is near 5%. Quantitative easing is over, at least in the U.S. The Fed is talking about raising rates later this year. And we are in the mature stages of this business cycle. With that in mind, do you think it would be wise to expect the same returns from the S&P 500 over the next 5 years as we have gotten in the last 5? I don't think so. So what is an investor to do? To answer that question, let's take a closer look at these two determinants of investment performance: earnings growth and the PE ratio. What is a PE ratio? When I was in high school, I had a math teacher named Mr. Giles who looked like Vince Lombardi. He had a crew cut and horn-rimmed glasses, and every day he wore a white short-sleeved shirt and a tie. But I didn't go to school in the 60s. I went in the 80s when everybody had long hair. So Mr. Giles was a bit of a throwback, and he wasn't as charismatic as Vince Lombardi. But he'd been teaching for 30 years, and he knew his stuff. And he knew that when we got to logarithms, the kids would freak out because it was such a foreign notation. So when we got to logarithms, Mr. Giles would walk around the class and say this over and over in his big baritone voice: a logarithm is an exponent. A logarithm is an exponent. A logarithm is an exponent. And what he was trying to say in his own way was, kids, don't freak out when you see this strange notation. It's just an exponent. And if you can understand exponents, you can understand logarithms. So I stand before you today in the spirit of Mr. Giles, and I say to you, a PE ratio is an interest rate. A PE ratio is an interest rate. A PE ratio is an interest rate. So let's talk about interest rates for a minute, then we'll transition to PE ratios. What is an interest rate? It is a measurement of income. If you go to the bank and ask, how much do your CDs pay? And the banker says 4%. That means if you invest $10,000, they will pay you $400. If you invest $100,000, they'll pay you $4,000. The banker is quoting you an interest rate, which is a measure of income. Interest rates can also be used to compare two income-producing investments. If one CD is paying 3% and another is paying 4%, which would you rather have? Interest rates make it easier to make smart investment decisions. And interest rates are quoted on a percentage basis. So let's take a look at historical interest rates. If you were a long-time bond investor, over the last 50 years, you've seen rates go up and down. But what would you say was a normal or average interest rate? 5, 6, 7. And when you saw rates get down to around 2, 3, or 4%, how did you feel? Pretty lame, right? Who could live on such paltry returns? How about when rates were in the 8, 9, or 10% range? Pretty good, right? I was talking to a guy on the golf course several years back, and he told me he had his money in muni bonds. He had locked them in a while ago at 8%, tax-free, and he was happy. Who wouldn't be? So as an investor, you have a pretty good sense of interest rates, when they're good and when they're not so good. Let's expand this discussion to real estate. Real estate is also an income-producing investment, but the income is not called interest or dividends, it's called rent, or for commercial real estate, NOI, or net operating income. And what is the measurement of that income called? The cap rate, which is just like an interest rate. So if you were a long-time real estate investor, what would you consider a normal cap rate? 6 or 7? 5 is okay, but it's starting to get a little risky. When cap rates get down to 3 or 4%, you know the market is getting a little frothy and it might be time to get out. And no investor would pay a 2 cap for real estate. But if they were able to pick up a property at an 8 or 9 cap rate, that is something worth bragging about. On the rare occasion that real estate is available at a 10 cap rate, it doesn't last long because at that rate, smart investors are on it like flies. Let me give you an example. Suppose there's a house selling for $240,000 and you can rent it out for $2,000 per month, which would be $24,000 per year. You can say that the house is selling for a cap rate of 10. So an investor might see that and say, wow, that house is selling at a 10 cap rate. It sounds like a good investment. I'm going to buy it. So he buys it. Other investors take notice that houses are selling near a 10 cap rate and they start buying up real estate. In a few years, the house has doubled in price. It's now selling for $480,000, but the rent is still $2,000 a month, which means the cap rate has come down to 5%. Mom and pop investor notice that real estate has really been going up lately and they decide, maybe we should get into the real estate game. Is now a better time to get into real estate than a few years ago, or worse? It's worse because the cap rate has gone from 10% down to 5%. But mom and pop don't notice that because they're only looking at the price. So mom and pop get into real estate and drive prices up even higher. At this point, the institutional investors are looking at 3 or 4 cap rates on real estate and say, this party's almost over. I'm going to take my profits and get out. Other small investors are noticing mom and pop making money and they think, maybe I should get in. As the institutional money exits the real estate market, prices come back down to a more normal level and the hapless mom and pop investors take a beating. Why? Because instead of looking at prices in relationship to income, the cap rate, they are only looking at prices. Seeing prices go up, they think it's a good investment. But it's next to impossible to make good investment decisions when you are only looking at the prices. That's why real estate retail investors can be good at making sound investment decisions when it comes to bonds and CDs. Obviously, a 4% CD is better than a 3%, because they're framing their decision in terms of the price relative to the income, which is the interest rate. Yet when it comes to real estate, they tend to make bad decisions because they are only focusing on price movements. Does that make sense? So let's now extend this discussion on interest rates to stocks. Stocks also generate an income, which is called earnings. The income measurement used for stocks is called the PE ratio. Remember what I said earlier, a PE ratio is an interest rate. Well, that's true, except that it's upside down. If you went to the bank and CDs were paying 1%, that means you would earn $1,000 for every $100,000 you invested. 1 over 100 is 1%. Well, on Wall Street, they do things upside down. They would say 100 over 1, a PE ratio of 100. 100 over 2 is not 2%, but a PE ratio of 50. 100 over 3 is a PE ratio of 33. 100 over 4 is a PE ratio of 25, and so forth. But you can see a PE ratio is really just an interest rate turned upside down. So if you were a long-time stock investor, what would you say has been the average or normal PE ratio over the last 50 years? About 15, which is interesting because it's about the same as normal historical cap rates on real estate and about the same as normal historical interest rates on investment grade bonds. A PE of 20 is okay. 25 and up is high. PE ratios are like golf scores, the lower the better. And PE ratios in the 10 to 13 range have historically represented good buying opportunities. You could go so far as to put these in ranges and call this 8 to 10% range a buy range, this 5 to 7% range a hold, and this 2 to 4% range a sell. Notice that normal rates of return are about the same for bonds, real estate, and stocks. Low rates are about the same, and what would generally be considered good rates are about the same. Why would that be? What would you say is riskier, bonds or real estate? Real estate's less liquid, they have vacancy risk and maintenance risk. Why wouldn't investors demand a higher rate? What do you get from real estate that you don't get from bonds? The answer is growth. A $100,000 bond 20 years later is still $100,000. What about real estate? A 3-bedroom, 2-bath house 20 years later is still a 3-bedroom, 2-bath house. But what has happened to the price of that house? It has probably gone up over time, generally keeping pace with inflation. So the minus for real estate for risk is offset by the plus for growth, and rates end up being about the same. What about stocks? Wouldn't you say that stocks tend to be riskier than both real estate and bonds? Then why the apparent parity in rates? It comes back to the same issue of growth. While real estate prices generally keep up with inflation over time, a house or a building can't grow. A single-story house doesn't grow to become a 2-story house unless you make a substantial additional investment. But it is natural for good companies to grow over time. Starbucks today has more locations than it had 20 years ago. McDonald's has more restaurants than it had 20 years ago. Walmart has more stores than it had 20 years ago. Southwest Airlines runs more routes than it ran 20 years ago. So while stocks may get 2 minuses for risk, you can say they get 2 pluses for growth, and normal rates work out to be about the same as bonds and real estate. I'm sure you know CD buyers who go from bank to bank looking for the best rates. What do you think investors are doing when bond rates are extremely low, like they are today? They're looking at real estate and stocks to see where they can get better rates. Money is generally in motion between and among these 3 investment categories looking for the best risk-adjusted rates of return, because rates tend to peak and trough at different times between the 3 categories. So now that we have a better understanding of interest rates and PE ratios, let's turn to the subject of earnings. How do companies grow earnings over time? Let's take a look at an income statement and a balance sheet. First, we need to start with a company that generates a profit. The question is, what do they do with their income? They have 3 basic choices, the same basic choices you have when you get your paycheck. They can spend it, they can pay down their liabilities, or they can buy assets. Just like you, when you get your paycheck, you can spend some, you can pay your bills with some, and hopefully you put some money away. At this point, we need to define some terms. An asset, for the purposes of this illustration, is defined as something which generates an income. By that definition, would your house be considered an asset? No, because it does not generate an income. How about a rental property? Yes, because it generates an income. How about a vacation home? Only if it generates an income. A liability is defined as something which generates an expense, like a boat. It generates a boat payment, slip rental, maintenance expenses, insurance expense. You get the idea. So let's go through an example so you can see how this works. Let's say there's a guy that works at the bank. He's been there 20 years. He started as a teller, and he's still a teller. He's never gotten a promotion, but he's never gotten fired either. But he does a few things right. With every paycheck, he spends less than he makes, he pays down his liabilities, and he buys more assets. If he makes $1,000 per paycheck, he spends $800. He pays down his liabilities with $100, and he buys more assets with $100. When we say he pays down his liabilities, what do we mean? He pays down his credit cards, he pays down his auto loan, he pays down his mortgage. When we say he buys more assets, what do we mean? He puts some money in a CD, he puts some money in his 401k, he puts some money in a mutual fund, he buys a property, etc. He puts some money in something which generates an income. Over time, as he's paying down his liabilities, what is happening to his liabilities? They're going down. They have to. And if his liabilities are going down, what is happening to his expenses? They're going down. They have to. He paid off a credit card, no more payment, etc. Over time, as he is buying more assets, what is happening to his assets? They're going up. And if his assets are going up, what is happening to his income? It's going up. It has to. Did he get a raise? No. Did he get a promotion? No. Did he invent something? No. Then how did his income go up? He got some interest from his CD, he got some dividends from his mutual funds, he got some rent from his properties, etc. Over time, if his assets are going up and his liabilities are going down, what is happening to his net worth? It's going up. It has to. Over time, if his income is going up and his expenses are going down, what is happening to his net income? It's going up. It has to. That is exactly how good companies grow over time. They spend less than they make, they pay down their liabilities, and they buy more assets. It works every time, it works over time, and it works for a long time. My favorite example of this is a company called 3M. What is 3M famous for? Post-it notes and Scotch tape. Who knows what 3M stands for? Minnesota Mining and Manufacturing. How did a mining and manufacturing company end up in the Post-it note and Scotch tape business? They spent less than they made, they paid down their liabilities, and they bought a Post-it note company. They bought a Scotch tape company. How long can they keep doing that? Forever. The average blue chip company pays out about 30% of its earnings in the form of dividends. That is the money they give to shareholders to spend however they want. What do they do with the other 70%? They pay down their liabilities and they buy more assets. That is why they're able to grow earnings over time, year over year, in good times and in bad. Imagine if you were able to do the same thing. If you were able to live off of 30% of your income. Let's say you make $100,000 per year and you live off of $30,000. You take the other $70,000 and you pay down your liabilities and you buy more assets. How long before you would end up out of debt? How long before you'd have a bunch of money saved up? How quickly would your net worth grow? How quickly would your net income grow? That is exactly what the best companies in America do on a regular basis. That is exactly how they're able to grow their earnings year over year in good times and in bad. So now that you understand earnings growth a little better and you understand the PE ratio better, let's go back to the beginning of the presentation when we looked at how the S&P 500 did over the last 5 years and consider what we might expect over the next 5 years. Considering that 5 years ago we were just coming out of the 2008-2009 bear market, whereas today we're 6 years into a bull market. 5 years ago unemployment was near 10%, whereas today it's near 5%. 5 years ago the Fed was kicking off quantitative easing rounds 1 followed by rounds 2 and 3, whereas today the Fed is talking about finally raising rates for the first time since 2006, and that 5 years ago we were in the very early stages of the business cycle, whereas today we're in the mature stages of the business cycle. Considering all these things, do you think earnings will grow at a faster rate over the next 5 years or slower? I personally think that it would be prudent to expect more moderate earnings growth in the next 5 years. Considering that 5 years ago the PE ratio on the S&P 500 was a modest 16 times earnings, whereas today the S&P 500 is trading at a more fully valued 20 times earnings, do you think it is more likely for the PE ratio to continue to expand or to moderate? I think over the next 5 years, the PE ratio is more likely to come down towards its historic mean. They asked Albert Einstein, what is the most powerful force in the universe? His answer was compound interest. Now, I'm no Einstein, but I believe there is a force in the universe which is at least as powerful as compound interest, and that is the mean, the law of averages. The mean has the strong tendency to pull things back to it over time. The longer they deviate from the mean, the stronger becomes the pull, until ultimately all things succumb to the all-powerful law of averages. I think over time, the PE ratio is going to come back down closer to his historical average. So let's go over a possible scenario for the S&P 500 over the next 5 years. Now, I'm in no way attempting to make any promises or guarantees. I'm just saying, considering the facts, what may be a possible outcome. In the last 5 years, earnings grew at an average annual rate of 8.81%. Let's say in the next 5 years, earnings were to grow at a more moderate rate of 6% annually. In the last 5 years, the PE ratio of the S&P expanded from 16 to 20 times earnings. Suppose over the next 5 years, the PE ratio moderates back down to 18 times earnings. What could we expect if that were the case? If we get earnings growth of 6% and the PE ratio goes down from 20 down to 18, we would see an average annual return of 5.25% on the S&P 500, not counting dividends. Now, 5.25 I guess is okay, but it is nowhere close to the 13.93 annualized return we saw over the last 5 years. I think most of my clients would like to see better than 5.25 plus dividends, but I don't think it would be prudent to expect more than that from the S&P 500 or other similarly diversified stock or mutual fund portfolios. If that's the case, what is an investor to do? Well, the market as a whole may have a hard time delivering above average earnings growth over the next 5 years. Do you think there will be individual companies whose earnings will grow faster than the market average? I do. And among those companies whose earnings are growing faster than the average, do you think there are some that can be purchased at reasonable and sustainable PE ratios? I believe so. Early in the business cycle, earnings growth is broad-based as a rising tide lifts all boats, and investing in an index or other broadly diversified portfolio often yields quite satisfactory results. But as we get into the more mature stages of the business cycle, it becomes more of a stock picker's market as winners and losers emerge, and simply diversifying broadly often leads to lackluster results. We can liken it to the difference between sailing and rowing. Early in the business cycle, you can sail to good returns simply having a broadly diversified stock portfolio. But as you get into the later stages of the business cycle, it requires the harder work of rowing or individual security selection to continue to move the boat. I believe we are moving into a stock picker's market where you are going to want an advisor who is looking for individual companies that stand to benefit in the current market environment. Let me go over with you what we look for in a portfolio company. We look for companies with the potential for better than average earnings growth that can be purchased at reasonable and sustainable PE ratios. There are 3 identifying traits of the companies we like to invest in. Number 1, strong free cash flow. Number 2, a philosophy of expansion. And 3, a long project list. Let me give you an example. There's a company out of San Diego called WD-40. They make a really good product and they have strong free cash flow, but they don't really have a philosophy of expansion. Why wouldn't they come up with another product or buy the company that makes the product on the shelf next to them? It seems they're content taking their comfortable profit margins on their one product and calling it a day. You're not going to get much earnings growth from a company like that. That's not the kind of company we're looking for. Compare that to a company like Procter & Gamble. They have good free cash flow from Tide laundry detergents. They take those profits and buy Downy fabric softener, and they can keep going down the aisle and buying Bounce dryer sheets and Gain laundry detergent and Mr. Clean household products, and they can keep that up for years and years, adding to their product line and growing their earnings. That's a company with strong free cash flow, a philosophy of expansion, and a long project list. I like to ask myself, if I worked in their M&A or mergers and acquisitions department, would I have job security? Would I know that when I'm done with this project, there will be another one waiting for me? So I build a portfolio of companies like that have a mechanism to deliver above average earnings growth that I can purchase at reasonable PE multiples. Let me give you a few more examples. Nike. They make running shoes, tennis shoes. How hard is it for them to also make football shoes, basketball shoes, soccer shoes, golf shoes? And once they're selling you their shoes, how hard is it to sell socks, shorts, shirts, jackets, and caps? And now they've gone beyond selling sportswear. They're selling the active, athletic lifestyle. Just do it, which was historically the domain of young men. But guess who else wears Nike? Women. The U.S. women just won the World Cup again. How is it in a sport where American men are so perennially terrible that our women are so dominant? Because in the U.S., our girls play sports. Our girls even do MMA. They're even Army Rangers. That's not the case in much of the rest of the world. It's not considered ladylike. But there is a generation of women rising up that want the active, athletic lifestyle, and Nike is going to be there to tell them, just do it. Did you see the most recent Olympics? There was a woman running track in a burqa, and it wasn't a big, heavy black burqa. It was a colorful, dry-fit fabric burqa, and I bet Nike made it. And she was a hero to a new generation of young girls in her country. Does Nike have new markets to expand into? You better believe it. When my dad used to go for a walk after dinner, he'd wear street shoes. Now, his generation wears Nike too. When my dad played golf, he wore wingtips, dress slacks, and a nice sweater. Now Nike is making huge inroads into the golf market. Tennis shoes and gym shorts isn't just for young men anymore. Nike is selling the lifestyle to women, older generations, and around the world. Nike has good free cash flow, a philosophy of expansion, and a long project list. I like Nike so much, I also have Under Armour in the portfolio. I have about 20 companies in the portfolio, and I can tell you a similar story about each one of them. We look for companies with good free cash flow, a philosophy of expansion, and a long project list. We believe companies like these can deliver above average earnings growth, and we try to pick them up at reasonable PE ratios. We believe we're in a market where individual companies like these can continue to deliver healthy returns for the disciplined and focused investor. So to summarize, I believe we're entering into a stock picker's market. I believe that in this market, companies that can deliver above average earnings growth and that can be purchased at reasonable PE multiples will do well. If you agree with me, I believe that I am the guy for you. I would welcome the opportunity to sit down with you one-on-one to better understand your situation, and together we can determine if this strategy might have a place in your overall investment portfolio. One of the side benefits of our approach to investing is that it is very cost efficient. Everybody expects to get paid for their work, right? Well, in the investment business, we're typically working for 1 to 1.5%. When you work with me, you work directly with the investment manager. That means there is only one level of fees to pay. My fee is normally 1 to 1.5%. If you work with an advisor that recommends mutual funds or third-party managers, now there are two levels of fees to pay, and you're typically looking at 2 to 3% all in. If your advisor recommends you place those investments inside an annuity, now there are 3 levels of fees: the insurance company, the investment manager, and the advisor, and you're typically looking at 3 to 4.5% all-in fees. I hope this presentation has been informative and helpful to you. Thank you for taking the time to listen all the way through. In today's busy world, time is precious. You can rest assured that I will always be respectful of the time you invest as we discuss the possibility of a mutually beneficial business relationship. If I can be of service, please don't hesitate to call.